You think you've got a great trading strategy. You're convinced it should work, and yet your account is telling a completely different story. Believe me, you're not alone. The majority of retail traders fail, not because they do not have good ideas or because they do not use the right techniques, but because they dive in trading headfirst without ever seriously testing their strategy. They see a method that looks nice in a video or in a book, they test it a few times on demo accounts, then jump straight into live trading. And the result is very often a financial and mental slap right in the face. Can you imagine a surgeon operating on a patient without ever having practiced before? It's madness, right? Well, that's basically what thousands of traders do every day. They rush into the markets without knowing if their method really works or not. And me too, I was one of them at the beginning. I was convinced I had found the magic method, a breakout setup on penny stocks taught by a guru. I executed it with confidence and even made money at first. But a few months later, I had burned through my first 1,000 euros. And you know what? I was totally confused. I didn't really understand why it had failed. Spoiler, I had skipped the crucial step, backtesting. So let me ask you the same question I should have asked myself back then. Has your strategy ever been tested on 5, 10, or 15 years of market history? Do you know how it reacts in a bull, bear, or flat market? In today's video, I'm going to explain why backtesting can make you a much better trader. So make sure you stick with me until the end. Alright, so concretely, what is backtesting? Well, it's simply testing a strategy on historical data to see how it would have performed in the past. Let's suppose, for example, that you have the following idea. You want to buy the Apple stock every time the 50-day exponential moving average crosses above the 200-day exponential moving average. And you want to sell if price goes up or down by 5%. So what do? You test these rules every time they happened over, let's say, the last 10 years. Then you check, would it have made a profit? What would have been the maximum drawdown? How many trades would it have required? What percentage of these trades would be winners? And basically, would it have been worth it to trade this strategy? Spoiler, in that case, not at all. But doing this work is a bit like going back in time and seeing if something would have worked until today. The goal is not to predict the future, but to prepare for it in the best possible way. In fact, backtesting turns an idea or intuition into a statistical, interpretable result. And that's what all professionals do. No hedge fund throws millions into the market without testing their strategies in every way possible first. And yet, retail traders risk their hard-earned money after only 5 winning trades on demo. And the beauty of all this is that you don't even need to be a developer to backtest your strategy. You can do it manually with a chart and an Excel sheet, or write your own program if you know how, or use a cloud backtesting app like Upside to be able to directly test your strategy from plain text. 15-second break to tell you that only until this Sunday, you can get minus 50% on all the plans with the promo code RUN. So don't miss this opportunity and get started right now on upside.com. Now back to the video. But no matter what method you use, the most important thing is that your backtest gives you clear answers. Is your strategy profitable? Is it robust in different market conditions? Can you mentally handle the drawdown it implies? These questions are important because a strategy that works on paper is good, but you still need to be able to execute properly afterwards. You might wonder, why is all of this crucial? When I first started trading, I was trading this French company stock, which is now a penny stock. And like many retail traders, I was so determined to succeed, full of energy and full of hope. I was following a strategy that I had found in a video with breakout setups and supernova concepts, promises of easy gains, and yeah, it looked super simple. But like I said, in a few months, I had lost my first 1,000 euros. And the worst part wasn't even the loss, it was the confusion that came with it. I didn't know if I was just unlucky or if I had done something wrong, or if the strategy was just garbage. That's when I realized something essential. If I'm not ready to see my strategy ideas fail in the past, then I have zero chance of success in live trading. So backtesting is not just numbers. It's a mirror that shows us the truth about the strategy with no filter. And that truth has several major advantages. First, you gain clarity. You stop dreaming or imagining that your strategy will work, and instead you confront it with reality. That shows whether it truly holds up or if it only works by chance. Second, It stops you from constantly hopping from one strategy to another. And that's actually one of the main reasons why retail traders fail. Traders who never backtest anything are always chasing the next miracle setup or the next edge. Whereas with a solid backtest, you build conviction and stay focused on one strategy that truly works. Third, it builds real confidence. You see the losses. You see that the strategy can recover from them. So when things go badly in live trading, you panic much less, simply because you know it's normal. Fourth, backtesting allows you to trade with discipline. No more emotions taking over. When you have a solid and reliable backtest history of your strategy, you stick to it, even when it gets tough. And fifth, you start thinking long-term. You stop judging a strategy on the next 3, 4, 5, or 10 trades. Instead, you judge it over years of historical data. And that makes you think not like a gambler, but just like a pro. So in short, backtesting is a mental and statistical safety net. It's what transforms an impulsive trader into a thoughtful trader. By the way, tell me honestly in the comments section, have you backtested the strategy that you're currently trading with? If not, but you want to seriously backtest your strategy, here is how to do it step by step. Step 1, define precise rules. A backtestable strategy is clear and codifiable. You must be able to write down your own entry rules, your exit rules, your position size, whether there's a stop loss or a take profit. You know your strategy is clear enough when there are no more questions about it on how it works, and nothing is left open to interpretation. Step 2, choose your market and your time frame. Do you want to trade Euro USD or the Tesla stock or Bitcoin? Do you want to trade on the 5-minute time frame or on the 1 hour, or use multiple time frames at once? Each market and each time frames has its own specific dynamics. Step 3, you need quality data, clear, reliable, and adjusted over time. And step 4, run your backtest, whether it's from a cloud backtesting platform like Upside, or your own program, or on a replay mode on a trading platform. Manual or automated, it doesn't matter. What matters is that you do it. And finally, step 5, analyze the metrics and KPIs, just like we did earlier on this Apple strategy. But be careful, backtesting is full of traps. Indeed, backtesting is powerful, but it's not a magic trick. Trap number 1 is bad data. If your data is wrong or of poor quality, then your backtest is useless. It's like testing a car with flat tires on an oily road. Absolutely worthless, and you'll learn nothing. So be ultra demanding with your data. At Upside, for example, we get ours from official exchanges: Euronext, CME, CBOT, COMEX, etc. Trap number 2 is overfitting, a classic mistake. That's when you trick every little parameter of your strategy to fit historical data perfectly. But in real life, as soon as the market changing, the strategy collapses. Trap number 3, forgetting fees, spread, commissions, slippage, etc. All of that can ruin a strategy. If you forget to include them, you'll get amazing results in the backtest that will actually never repeat in reality. And finally, trap number 4 is believing that the work is finished. Even a great backtest guarantees nothing. Markets evolve, and a winning strategy until today may not work tomorrow. So you must keep testing, adapting, stay flexible, and develop new strategy ideas. But behind all this work, there is a huge advantage. It's what it brings to you mentally. When you have a backtested strategy, you know whether it can handle a losing streak or not. You know what to expect, and you don't panic at every dip. With a backtested strategy, you trade with confidence, serenity, and discipline. You don't start questioning everything after 4 or 5 losing trades. And you don't change plans every time you see a new method on a new YouTube video. And then, you know what? Trading becomes boring. No more drama, no more YOLO, just a clear process that you follow with rigor. And when your trading becomes boring, that's when you very likely just became profitable. So now tell me in the comments, have you ever backtested a strategy? And if not, are you going to start doing so? I hope you enjoyed this video. If it was of any usefulness to you, feel free to hit the like button, leave a comment, or subscribe to the channel. As for me, I'll see you in the next one. Bye.